Welcome to Marathon Money Inside the Ticker, and I'm back with SKYQ, who was Marcus, the CEO, who was on the show last year. I'm excited to have him back on, and I'm hoping to really talk about what they've been doing. For y'all who don't know, and I want to be corrected on this, but from my understanding, that you guys are basically in sand refine of oil sands. Am I correct from the last time we talked?
Yeah, that's
Do
part
I
of our
remember it?
business. Yeah, that's part of our
As
business.
part of your
Yep.
business, and
Yeah.
I know you guys also make, you got digital assets, tokenized carbon credit multiplication, and recycling, refining waste, uh, asphalt shingles. Am I correct on that? From what last time when I remembered.
Yeah, absolutely.
So, like, tell me, what you guys been up to, man? What couple? I know last year you guys kind of IPO'd. Now it's time. You guys kind of got your bearings that first year. What's going on now?
Yeah. Um, yeah. I'll just start with a little bit of an explanation on the assets that we have. We have two different operating facilities. One is a refinery that takes oil from the Utah and Nevada market and refines it for customers in that market. And then the other platform we have is a extraction facility for the oil sand, and that's in Utah. And so those two facilities are a couple of 100 miles apart. The extraction facility in Utah, to refresh your memory, was built at a cost of $50 million. It's sitting on a resource that is equivalent to 180 million barrels of oil, which is part of probably one of the largest oil resources in the U.S. that isn't really being tapped right now. And so our facility in Utah is almost completed with a retrofitting. And once that's complete, it's been designed for 2,000 barrels a day of production. And the idea is we can take that oil production out of the oil sand, and that facility will also handle the waste shingle material. And between those two feedstocks, we should be supplying oil to our refinery, for the kind of Utah, Nevada market as we move forward. So currently we're operating the refinery. We're in the process of finishing the retrofitting for the Utah facility, but ultimately we intend to be running both facilities and then expanding from there. But the Utah facility has a capacity of 2,000 barrels a day, and then the refinery has a capacity of 5,000 barrels a day.
And those are like, when would those be activated? Or
The
like, when
refineries,
do we see those?
the refinery is operating today, so that's the source of the revenue that we're reporting to the market.
Okay.
And it's not operating at near capacity, so we're in the process of building up production there, or building up the refining. And the interesting thing about that opportunity is, Nevada. We are the only refinery in Nevada, and Nevada buys most of their uh, fuel from California, and we're about to experience some interesting market dynamics because two of the biggest refineries in California are going offline permanently. And that's a little bit triggered by Gavin Newsom and his rulemaking and what they've done in California. And so the opportunity for us is to really build up our production so that we're taking that supply that's disappearing from Nevada and making it a local product. So we're pretty excited about that.
That sounds really well. I do want to take a step back and talk about, where are you guys on the production? I know you guys said the potential is 5,000. Where is that in the lines of like production right now?
We're probably running at about 20% of capacity, 10 to 20%. So we really have a lot of upside available to us in increasing in refining production in Nevada. And our goal is to get that production up to 80, 85, 90% of our capacity. As I said, the capacity is 5,000 barrels a day.
Yeah. Do you have is it something you guys are shooting for Q2, Q3, Q4 of next year, and you guys have clients already lined up that's already, knocking at your door for something you guys are already doing?
Yeah, we have, the beauty of selling a commodity product is there's always really kind of buyers for fuel. You're ultimately just taking a market price. So the beauty of the current opportunity with these refineries going down in California is that the pricing will probably get higher, and the spread that we make between what we buy oil for and what we can sell it for will probably increase. And so that ramp up is probably going to occur over the next 12 months.
Why is that happening? Why is the refineries in California going down? And I know that leaves you guys like kind of like an opportunity to squeeze in and make a big play on market share. But can you explain why
Yes,
that's happening?
yeah. There's two. Well, Gavin Newsom kind of, if you look at some of the regulatory stuff that's happened in California, California operates as its own. They call it an island because it's not really connected to the rest of the United States as far as fuel supply. There's no pipeline between Texas and California. So California supplies Nevada and Arizona most of its fuel. And so what happened is because of disruptions in supply and other things, there were two big price spikes in California. And California already has the highest gasoline prices in the country. But there are price spikes that drove the gasoline up even higher over the last 5 years, specifically kind of at the end of COVID. And so Newsom put in regulations that required refineries to essentially tell a new government agency when they were going to take their refineries down and how they intended to provide supply during their downtime, and effectively have to get permission for it, or expose themselves to fines of $1 million a day. And Phillips 66 has a refinery in Los Angeles area that does about 9% of California consumption. The problem is the refinery is so old that it was built in the middle of nowhere 100 years ago, which is now a residential area. And I think they're worried a little bit about litigation because their house is built right up against the walls of the refinery. And so I think Phillips 66 is basically worrying about liability and saying, you know what, let's just downshift from here, sell off the land. They have 650 acres of land, which is effectively waterfront in California, and we're gonna stop operating here because the liability is too big. In Valero's case, they have a refinery that's about 9% of the market share in California, which is the newest permitted refinery in California, and they're just taking it down because the constraints that California is putting on make it an unattractive market for them. California demands that refiners make a specific gasoline only for the California market. And so all the regulations that California put in place, these big refining companies are like, listen, we can make more money elsewhere and not have the headache and not have the liability. And so they're leaving the market completely.
Wow, that opens like how much market share is California? Now you said it was like almost like 60%, right?
California delivers more like 90% of the fuel that's sold in Nevada today. And,
Okay.
California is obviously pushing the electric car, kind of mandate by thinking that about 30% of cars in California are going to be electric. And, the California market's not following through. So California is happy to see the refineries go away because they're trying to force the issue of not having any gasoline powered cars on the road. But if you look at the demand for fuel in Nevada, it's never gone down, and very little of Nevada is really effectively accessible with electric cars because most of the time when you drive around Nevada, you're going further than the range of an electric car today, and there's very little opportunity to charge it back up. And so, unless you're in Las Vegas, you're not really able to drive an electric car. So fuel demand in Nevada has never gone down. It's always gone up year after year. So there's about 150,000 barrels a day of fuel demand for Nevada, and 90% of that was coming from California. And the fear is that once these refineries shut down, the other refineries won't really have capacity to sell into Nevada. And the new regulations from Newsom also require that refineries keep 2 weeks of inventory on hand at all times. So, the refineries don't really have the luxury of selling everything that they make because they have to keep so much in inventory. So it increases their working capital. It's become an unattractive market for the big boys.
So with that being understood, like I'm starting to get the grasp of like where your market opportunity is. You're at like 20% production capacity right now. Am I correct?
Correct.
So realistically, what's the plan to close the gap and get those market opportunities so you'll be ready when things do go that way?
It's really just a matter of increasing our working capital to the point where we can access enough crude to meet the demand required by increasing our capacity. Like I said, the demand is there. As you can imagine, I'm sure you talk to a bunch of mining companies here and there. The mining business is booming in Nevada right now because you have the biggest gold mines and the biggest lithium mines in the United States are in Nevada. So Nevada is mining country, and you can't dig a hole, without diesel. And so we're getting approached, by big mining companies that want to buy diesel direct because they know that there's going to be a supply squeeze. So it's really just a matter of making sure that market participants are aware that you exist and setting up supply agreements. So it goes hand in hand. Building capacity. We have the capacity, so we're accessing some working capital to be able to buy more crude, and then we'll be refining it for our customers.
So you do have customers lined up, ready, because they're noticing the squeeze is coming.
We have received inquiries from customers that want to buy significant blocks of our production capacity. So we're in discussions with them.
Phenomenal.
Yeah.
That's phenomenal. That's great. So what about your other source of revenues that you guys make? I know we spoke about last time, your environmental remedies, your digital asset tokenization, your carbon credits. Let's get on to some of those. Have you guys made improvement, or you guys have been just focus on just like the refinery and making sure, because that market really coming close soon?
Yeah. So we're continuing the retrofitting process of our Utah facility. And, on the back of, digital asset tokenization, you've seen a lot of these digital treasury deals. And, one of the ways that we're looking to increase our working capital is to actually create real world asset tokens around our oil supply, around our resources that we have. So, as I said, our leases are about 180 million barrels of oil equivalent in the form of oil sand. And, we're looking at purchasing other reserves as well. And if we can tokenize those reserves as an oil token, we're looking to work with our suppliers to take those tokens as collateral, as lines of credit for the product that we want to buy, and that will increase our working capital. And ultimately, if we're successful in getting our suppliers to take tokens as collateral, we consider that a potential product as a service that we can then license or provide to other energy companies, because you have thousands upon thousands of minor small player energy companies that are strapped for cash, that don't have access to working capital, that if they could tokenize the assets that they have and provide that asset to their customer base or to their supplier base to increase their working capital, it becomes a huge opportunity for them. There's about $300 billion tied up in working capital of energy companies just on the oil and gas side in the United States. And if you can increase that working capital, you can multiply the revenue of those companies, you know, in lockstep, right? Because every dollar of working capital that a company has, if you're rotating through that working capital once a month, you can increase the revenues of that company by 12x. And so, we're looking for creative solutions to monetize or create transportability of these assets so that companies can grow more quickly. I'm sure you're well aware that energy demand that's being created through AI and these data centers, and the country is now aligned and focused on increasing energy supply across all different categories, whether it's solar, whether it's electricity, whether it's natural gas or oil, and so we have an amazing opportunity to increase the productivity of these energy companies across the country by creating an oil token, for example, or a carbon credit token that can then be held in trust as an asset to support the growth in business. So that's one thing that we're working on. I have a team that I've worked with for years that's got an exchange capability where we can create the token, get it compliant, and then provide it to our suppliers so that they're willing to extend us more credit so that we can increase our revenue. So it's that's been a lot of work in the past 6 months with what's happened in Washington as far as the stablecoin and tokenization efforts that the government's doing.
I do want to ask you a question because I do understand everything you're saying about tokenization and about getting the customers or clients to be able to take them to use them as collateral. But there is I'm thinking with the production you guys have coming up and what you guys are already doing to take advantage of the California market, also AI data centers that's happening in the middle of the country in Texas, and they're going to
Yeah.
need a lot of energy.
Yeah.
You know what I mean? Is anything in your plan and in your vision to start maybe going after customers like that? Because AI data center is going to need an extreme amount of energy, and oil brings that type of energy.
Yeah. So we're looking into that. The one thing that very few people know is in our Utah facility we actually have two cogen turbines, natural gas turbines, and that's what's actually very thin on the ground in the market today. So a lot of these AI or data centers are being built around their own power supply, and so if you look at these gas turbines, they're very cheap. They're one of the cheapest ways that you can make electricity, and especially if they're cogen. So the waiting list for these turbines is going out to 3 to 5 years, depending on who the manufacturer is. And at our Utah facility, we have two turbines that have a capacity of probably about 5 megawatts total that have a replacement cost in the $20 million range, and we have two of them that we're not currently using. So we're actually looking to potentially partner with somebody that could use those turbines to power a small data center. So we're looking to get into that business right now, and it's ironic that our stock is so attractively priced when the value of these assets that we have is a multiple of where our stock is trading. I lost you, Kenny. I can't hear you.
Yeah, no, I'm sorry. I was saying that you guys have a lot of potential for like real growth here with the two
Yeah.
turbines you guys have for AI data center. You know, what I mean, right now your production at 20%. There's a market that's about to open in California in 12 months. You guys are working to get yourself up to 80 to 90%. What should investors look out for? And like first quarter, second quarter of next year that they should pay attention to, because right now you are right. Your stock is attractive. You know what I
Yeah.
mean? And with so much growth in front of you, what should we pay attention to? Why should we hold this stock long term?
Well, we're hopefully we're at a trough here, and we've kind of reached the bottom of where our stock is. And I think we're going to be very proactive as far as communicating all of our potential business initiatives. So whether it's digital treasury, whether it's real world asset tokenization, as well as increasing productivity at our refinery, and then obviously whatever we do with our turbines, and also finishing up the Utah facility and getting that recycling shingles, as well as producing oil. So we have these 5 business fronts, and all of them have a ton of upside and a ton of margin tied into them. So it's really just following the story and looking for execution. But I'm really excited. Obviously I've been settling into the CEO role for a couple of months now, but the opportunities that we're getting are massive, and it's really just a matter of locking everything down and moving forward. And I'm really excited.
I really like what I'm hearing. And also, your company, you guys can go after. I know with everything going on with the government shutdown, not trying to get too much into that, but like there's opportunities for future government contract because even the government is starting to set into the AI data center, and you guys have those 2 turbines. While I'm thinking about it, you know what I mean? Do you guys see yourself getting more? Because like you guys have oil, you guys have actual commodities that the world needs. You guys can do something in mass. You know what I
Absolutely.
mean? And you guys already know how to do it. You guys can
Yep.
actually do something in mass waves and actually do something that potentially feeds people or pay people, or people can make opportunities as what you guys do.
Yeah. No, we're very lucky because we kind of have a core business that has been around for a long time, which is the oil refinery, and we have customers that have been with us for 20 years that we essentially are legacy customers. So we have that base business and stability from those customers, but we also have a lot of blue sky in the form of all these business opportunities that we face, and the fact that we're NASDAQ listed and we have all these kind of business opportunities ahead of us. It really gives us a bright future. And so I'm excited about kind of taking the reins and moving this opportunity forward.
Man, Marcus, I appreciate you coming on the show. Honestly, to tell you the truth, I really do. I really appreciate you coming on the show, and I'm definitely hoping that we can catch up another time and talk about this because the truth is, I do think your company is extremely undervalued, and I think you guys have a lot of growth, definitely with your plan that you guys see for the future. And I definitely want to know what in a few months see how everything's going for you and then some of the milestones you hit.
Yeah, no, I'm looking forward to sharing again. I'd be happy to come back and say the first quarter, second quarter.
Oh man, appreciate it. Um, Thanks for everyone for listening and watching. Uh, this is Marathon Money Inside the Ticker. Thanks, Marcus, for coming out. I appreciate it.
Thank you. Have a good one.